All right, let's jump right in. Today, we're going to pull back the curtain on the economy's master control panel. We're talking about the powerful toolkit that central banks use to keep everything, and I mean everything, from the price of your groceries to the interest on your car loan, running smoothly. So, let's start with the question you've probably asked yourself. I mean, you've noticed it, right? Prices for, well, pretty much everything just seem to keep creeping up. That whole phenomenon? It's called inflation. And believe it or not, managing it is one of the biggest jobs in the entire economy. So, who's in charge here?
That job? It belongs to the central bank. And honestly, the best way to think about it is like a thermostat for the economy. Its main goal is just to keep things stable. Not too hot, that's runaway inflation, and not too cold, which is when prices start falling and everything stagnates. That's a state we call deflation.
Okay, so how exactly does the central bank tweak this thermostat? Well, it has a very specific set of tools, and we can basically split them into two main types. You've got your big, heavy-duty sledgehammers, and then you've got your fine, precise scalpels.
And this slide just nails the difference, doesn't it? On one side, you have the quantitative tools. These are the sledgehammers. They affect the entire system, the total amount of money and credit available to everyone. And on the other side, you've got the qualitative tools, the scalpels. These are for super precise adjustments, targeting the flow of money to very specific corners of the economy.
All right, let's dive into those sledgehammers first. These are the tools that control the total amount of money sloshing around in the economy. When a central bank wants to make a really big move, this is the drawer they open.
Okay, there's a lot on this slide I know, but here's the cool part. All these different sledgehammers are trying to do the exact same thing, control the total money supply. Let's do a quick run-through. First step, you have key interest rates, like the repo rate and the bank rate. Just think of these as the price banks pay to borrow money. If the central bank jacks up these rates, it gets more expensive for banks, so guess what? They lend less money out to you and me. Simple. Then there are open market operations. This is basically the central bank buying or selling government bonds. When it sells them, it literally sucks cash right out of the financial system. And finally, you've got things like the CRR and SLR. These are just rules about how much cash banks have to keep on hand. If the central bank increases those requirements, banks have less money available to lend out. See the pattern? All these actions, when you turn them up, shrink the amount of money in the economy.
Okay, so that's the heavy-duty stuff. Now let's move on to the second drawer in the toolbox. We're talking about the scalpels now, the qualitative tools. The goal here isn't to change the total amount of money, but to guide where it flows and what it's used for.
A really important one here is the margin requirement. I know, it sounds super technical, but it's actually pretty simple. It's just a safety buffer. It's the difference between the value of something you put up for a loan, say some property, and the amount of cash the bank is willing to give you for it.
And here's how that works in the real world. Let's say the central bank is getting nervous that too much borrowing is making the economy overheat. Well, it can just increase that margin requirement. All of a sudden, your $100 piece of collateral only gets you a $70 loan, instead of the $90 you were hoping for. That difference? Well, it makes you think twice about borrowing, right? It cools things down without slamming the brakes on the entire economy.
And there are a couple of other precision tools too. You've got moral suasion, which is basically the central bank calling up the other banks and saying, hey, we'd really appreciate it if you'd get with the program. It's informal pressure. Think serious meetings or a strongly worded letter. Then there's selective credit control. This is where the central bank can say, okay, no more loans for that specific activity, like maybe some risky speculation to stop a dangerous bubble from forming in just one part of the economy.
So here's the most important part. It's how these sledgehammers and scalpels are used together. Central banks have a playbook, a strategy guide, for dealing with the economy's two biggest headaches: inflation, too hot, and deflation, too cold. Now, this playbook might look pretty clear on paper, but putting it into action in the real, messy world, that's a whole different story.
Okay, let's look at the playbook for fighting inflation. The goal is simple: reduce the money supply and cool things down. So what do? Step 1, hike all the key rates, make borrowing expensive. Step 2, sell government bonds to suck cash out of the system. Then they grab the scalpels to increase those margin requirements and clamp down on credit in any specific areas that are getting a little too wild.
And what about when they're fighting deflation? You guessed it. They just flip the playbook upside down. To get the economy moving again, they cut rates to make borrowing super cheap. They buy up securities to inject a ton of cash right into the system. And they lower margin requirements to get banks lending and people investing again. It's the mirror image of the inflation fight.
But look, at the end of the day, this isn't a one-and-done kind of deal. You don't just hit a button and fix the economy. It's a constant, never-ending balancing act.
The central bank is always watching, always tweaking, always trying to keep the whole thing right in that sweet spot of stable, steady growth.
And this quote really sums it all up, doesn't it? Every single tool we've talked about, every move the central bank makes, it all comes back to this one fundamental mission: managing the country's money to keep prices stable and predictable. That's what a healthy economy is built on.
So, what's the big takeaway here? It's that central banks aren't just winging it. They have a really sophisticated set of tools. They've got the sledgehammers for the big picture, and they've got the scalpels for the fine-tuning. And they're using them all the time, to try and keep our economic engine humming along perfectly.
And that leaves us with one last big question. We've seen the toolkit, we've seen the playbook. It all seems pretty clear, right? So why is it so dang hard to get it right? Why do we still have these massive economic booms and busts? Thinking about that, well, it really shows you just how complicated this whole balancing act really is.